Good afternoon. Thank you for joining us for our Navigating the Home Buying Process webinar with an emphasis on how to obtain a home loan. I'm Corby Gage, the Executive Director of Coastal Housing Partnership. And with us today is also Kim Pascage, Program Manager for Coastal Housing Partnership. And today's webinar features 3 local loan officers, and we appreciate you all being here. Silverio Garcia with Silver Mortgage Group, Liz Heitman with Guaranteed Rate, and Cindy Nunez with Guild Mortgage. So Silverio, Liz, and Cindy are all part of Coastal Housing Partnership's network. And as a network partner, these lenders reduce their closing cost for their clients who are employees that are part of Coastal Housing Partnership. We have a number of network partners that we work with in addition to our lenders. We also have real estate agents and home inspection firms that offer significant savings on your closing costs. So when you're selecting members of your home buying team, you want to check out that network and see how you can save money with the network partners through Coastal Housing Partnership. And we'll talk about that in more detail through our time together, but there are really great ways for you to save on your closing costs and generally reducing those by 50% or more. So that's a great benefit. The format for today's webinar is I'll be asking Liz, Cindy, and Silverio some questions about the process of obtaining a home loan and, being in that readiness position to purchase a home. The remainder of our time together will be to get your questions answered. That's an important part of this webinar. We'll be recording today's webinar, so we can send you a link to the recording. And the webinar format, this is a webinar, not a meeting. So it means that your cameras are off and your microphones are off. So we can't see you or hear you. So if you have questions, please put them in the Q&A and you can put them in there at any time during our webinar. We're going to get to those toward the end of our time together. You can ask your questions anonymously if you like. There's a little button that says anonymous. You can do it that way. And if you have any questions in terms of kind of technical issues, throw those into the chat and Kim will be monitoring that to see if there's anything we can do to help you with that. But hopefully we won't have any problems. So the first step in the home buying process is meeting with a lender to find out how much of a loan you can afford. And so the information you're going to receive today is going to make you much better prepared to make that important first step of becoming a homeowner. We really want to encourage you to take that step and meet with a lender, and they're always happy to meet with you and walk you through the process and help you with answer any questions you have and guide you along the way. So let's get started. Silverio, would you please share a little bit about yourself?
Sure, thank you. My name is Silverio Garcia. I mainly service, for the most part, Ventura County. I've been in lending for a little bit over 20 years, and my focus throughout my career has been 100% residential lending. And obviously, like all of us here in this panel, we specialize in, every sort of loans, such, conventional FHA, first-time home buyer options, and in general, again, servicing Ventura County.
Great, thank you.
You're welcome.
Liz, would you please share a little bit about yourself?
Hi, I'm Liz Heitman, and I've been in lending for more than 30 years, currently with Guaranteed Rate. I service the Santa Barbara area primarily, but like all of us on the panel, we're licensed in California and can lend throughout California, and even some of us have licenses in other states. I am also certified as a life coach and personal finance advisor, which helps me take a holistic approach to my clients. And I'm really happy to be here today. So thank you for inviting me.
Thank you, Liz. Cindy, would you share a little bit about yourself?
Yes, thank you, Corby. I'm Cindy Nunez. I am with Guild Mortgage, been with them since 2009. in the industry 30 plus years. Hard to say, but true. Just specializing in really working with first-time buyers, investors. We just acquired a reverse division, so I'm working on that as well. I'm just loving helping buyers of all types. So it's fun to see my coworkers who've done well in their careers this long in. And so I really enjoy being with you guys today and look forward to it.
Well, thank you. We're honored to have you three as panelists today and sharing your wealth of information with our attendees. So thanks again. Liz, let's get started with you. When is, it's always a big question. When is the right time for a potential homeowner to meet with a lender? Do they need to be ready to buy, or is it a good idea, to meet with a lender, sooner rather than later?
Absolutely. The right time is as soon as you start to think about buying a home. I have had first-time home buyers who thought they weren't ready and were very nervous about meeting with a lender, only to find out that they did have the ability to buy right now. I've had other first-time home buyers that needed some guidance, and I've worked with some buyers for up to 3 years before they were ready to buy and found the home they wanted to buy. So it's right now is the right time, and especially in this market, we have very competitive situation and low inventory still, even despite the recent run up in interest rates. So you really want to be prepared and know what you can afford so that you can move quickly and have as few contingencies as possible. And what do I mean by contingencies? Well, that has to do with being pre-approved for a loan, and that the realtor knows that you're already ready to go, so that there's no question about your qualifying.
So a lender's really happy to work with you, even if you're not ready to buy for a couple of years?
Absolutely. We want you to be as ready as possible. We want to have a successful transaction. And it's a relationship with your lender these days that's not dissimilar to the relationship with your realtor. Your realtor's helping you to find the right home, and that can take months or longer. The lender is now helping you to find the right time to buy, to be sure you're ready financially for this, and make sure that it's a home payment scenario that you're really able to handle long term.
Right. Well, you mentioned the pre-approval. What is the pre-approval, and why is that important? So
pre-approval is kind of a general term that can have different meanings. So we used to just say, oh, I'm pre-qualified, or you're pre-qualified. And that basically meant you talked to a lender, you might have filled out an application, and they said, yeah, you can afford this house. These days, with guidelines more strict, that's not good enough. And you want to be fully pre-approved or fully credit approved. A pre-approval means that you have not only given your lender your loan application, they've actually run a credit report, and they've received your documentation regarding your income, your assets, meaning liquidity, retirement accounts, anything that will help you with down payment, reserves, or even just in planning to be comfortable for emergencies. And they want to know your liabilities. What do you owe? What are your other debts?
Okay, and so is there a charge for pre-approval? Does someone have to pay for that process?
No, there's no charge for pre-approval. In the lending industry, we're paid when we successfully close the loan. We're paid on commission, so there's no charge up front.
Okay, so there's no reason for someone not to take that step to get that pre-approval and be in that readiness position.
Correct. There's no reason at all. And there are so many factors that go into preparing for buying a home and qualifying for the loan. If you don't qualify now, you really do want to know, do I need to pay off debt to qualify? How much more do I need to save? Do I need to improve my credit scores? And, maybe you have a spouse that has self-employed income. You may be W-2, but there's self-employed income. And are there enough what we would call add backs. Those are paper write-offs that we can add back to increase the income for your spouse, or maybe you have a second job. So we want to be able to look at all of that, make sure we're really looking at every aspect of your finances to help you.
It sounds like it's a lot more complex than just looking at a mortgage loan calculator online, that you're really looking at, really taking a deep dive into someone's financial situation and what works best for them in terms of getting a loan. What about financial documentation? What would they need to bring into you to get that pre-approval?
Usually we want at least 1 and sometimes 2 months bank statements. And that would be for liquid assets and retirement accounts. Sometimes there are assets that may help with qualifying that someone wouldn't think about. We would like income documentation. If there's only salaried borrowers involved, then W-2s and pay stubs. If there's any type of self-employed income or any ownership of stock or real estate, we'd also need tax returns.
Great. So helpful. Silverio, let's talk about credit scores. Everyone's always curious about credit scores and what they might be able to do to improve their score, or what's involved in that. Why is the credit score so important in the home buying process?
All right, so thank you. That's a great question. So credit scores are really important because they allow us to understand the type of mortgage loan that the client can qualify for. For example, there are mortgages right now that you can qualify with, sometimes even with 580 FICO score, but whomever has a slight clue about credit scores, we understand that FICO scores in the 500s, they are, quite damaged. Anything in the 600s, it's a little more acceptable. And then when you are in the 7s or even in the 800s, it's more acceptable. So every type of mortgage that you qualify for will be reflected in part by the actual FICO scores. In today's market, lenders do want to see slightly higher FICO scores. So, in general, if your FICO score is in the, in the early to mid 700s, it's a lot better than if you're in the 5 or in the 6s.
Okay. If you are trying to improve your score and because obviously they're dynamic, not static. So if someone does have a score in the high 5s and is trying to get that improved, is it a good idea for them to kind of work on that, or should they meet with the lender first and maybe
Absolutely.
find what they should be doing?
Yeah, part of what Liz was explaining is, it's doing an inquiry. So, there's a lot of confusion right now because some lenders are offering what is called a soft credit report and then a hard inquiry. Those two credit reports can vary depending on when and how ready you are to actually, get involved with purchasing a property. In my personal opinion, the hard inquiry is the most effective because that's for somebody who's ready to purchase right now. For the most part, us as lenders, we have the ability to look at different parameters and utilize tools such as what if credit reports. And what that means is that our credit reports usually come equipped with a what if simulator. It allows us to immediately understand if the client has the ability to improve their credit rapidly. When I say rapidly, I'm talking to you between 3 and 7 business days. Now, how do you do that? There's no magic, potion, for that. But what it is that some of our clients may have a little extra debt on their credit cards, or maybe they've forgot to pay something off. And we just let them know what actions they need to take. And then we submit it back to our credit agencies. And then within 3 to 7 business days, we're able to help them improve. For the most part, that is something that most lenders will provide. And we definitely encourage to always ask your lender, what is your middle score, which is my next, the next portion. We all have 3 credit scores for the most part. If you are much newer to credit, you may not have the 3 scores. But if you have those 3 scores, is Experian, TransUnion, and Equifax. Typically, what we do is we eliminate the highest, we eliminate the lowest, and we keep the middle score. Now, it could be, I've seen everything. I could see, somebody that has a really high FICO score on one and a really low FICO score on the other one, and a middle score that it's acceptable. So sometimes, in theory, we can get a little lucky with FICO scores, but it is important for you to continue to monitor your credit through various applications like Experian and TransUnion, or even Equifax, they have their own applications.
Now, if someone has a credit card where they get their credit score, is that good enough, or do they really need to be looking at the mortgage loan credit score?
Corby, that's a great question. That's usually what most of our clients would ask and say, hey, look, I have a credit report or I have a credit score through, CreditWise or whatever the case it is, even Credit Karma or any of those institutions. Unfortunately, those are consumer credit reports. They're not necessarily FICO scores. And for the most part, they're completely different than what your FICO score would be. In order for you to obtain an actual FICO score, we do need to actually run it through our system and pay for that. So, as part of the pre-approval process, like Liz was mentioning, the lender does, incur a fairly large cost, which is a credit report fee. And that credit report could range between, $60 to $100 and some dollars, depending. And that's practically the only way that an actual lender, when you're going through a full pre-qualification, as Liz was mentioning, that's when we actually start noticing what your real scores are. So no, do not utilize your credit card, FICO score as a gauge of your current score.
And are there things that you would recommend people not do when they're kind of getting ready to buy a home in terms of their credit or trying to improve their score? I know, a lot of times people will say, well, I'm trying to pay off my car loan. I only have, 6 months left. I'm going to pay that off so that's not showing up as debt. Are there things that, you'd recommend people not do and maybe things that they should do?
That's a great question as well. So ultimately, we recommend our clients to not utilize their credit cards as much or, diminish their credit utilization. The other thing is, for the most part, credit cards basically are the ones that have the most weight on your credit. So if you are making a car payment, usually a car payment will not affect your credit as much as your credit card utilization. For some products like conventional lending, if you have a certain amount of payments left on your vehicle, which for the most part is 10 payments or less, and you have an installment payment, meaning that it's just a simple car payment. Sometimes we don't take that into consideration. So paying off a vehicle may not necessarily be as wise as utilizing some of those funds to be able to reduce the amount of your credit card utilization. But warning, not because you pay down your credit card, it means that your credit score is going to go up. So that's why it's important for you to, talk to a local, mortgage professional to assist you and guide you through that process, because for the most part, it is impossible for you as a consumer to know what actions are needed to increase your FICO score effectively until you meet with somebody like us.
And sometimes it seems like they can be counterintuitive as to something you think is going to be helpful, and maybe it sends the credit score the wrong
paying
way.
off a credit card sometimes may actually adversely, affect your credit.
Mhm. So lenders look at these credit reports, credit scores all day long. They know kind of exactly what's impacting someone negatively and what steps to take. So it seems like that's another good reason to get the lender sooner rather than later.
Yeah, most definitely. And, as far as, somebody who would be starting or establishing their credit, maybe somebody younger or somebody that's thinking of purchasing a property, in the near future, also not overreacting with their credit. A lot of people try to go to various different stores and try to get credit in different places. Please understand that, having multiple inquiries can also affect your credit as well. So you have to be very strategic as to when and how you're applying for credit. Typically, an established credit history or credit report should have, I would say, between 3 and 5 credit cards the most, but I would say 3 credit cards established for at least 24 months. It's a good solid start of your credit. So don't go and try to apply credit cards in every store that you can think of. Be strategic in why you want to use those credit cards. It could be travel points that you want to gain, or I don't know, gas or whatever the case it is, but be specific and be wise on how many times you're running your credit.
Okay, great. Thank you. That's such a big topic for everyone. So thank you for sharing that. So Cindy, we are always getting asked, what about first-time homebuyer programs? Are there specific loans for me? How do I go about taking advantage of those? So like, who is considered a first-time homebuyer? Are there definitions around that, and are there specific first-time home buyer programs available that are valuable for people to explore?
I do have a lot of information on that for you guys today. So we will start with the definition varies depending on the agency who is awarding the program. So there can be Fannie Mae and Freddie Mac, who are traditional backers of conventional loans. There's the California Housing Finance Agency. There's a Housing Trust Fund of Santa Barbara County. There is also the Golden State Finance Authority that has a new program that they announced yesterday. So there are a ton of agencies right now where you're able to get some help as a first-time buyer. The guideline for a first-time buyer can vary. For instance, CalHFA is you can't have ownership in a primary residence in the last 3 years. Fannie Mae and Freddie Mac have a different definition. The Housing Trust Fund of Santa Barbara County is never owned a home. So they each have their own specifications. So I encourage you to get with a reputable lender if you want to investigate all of those options. Now, as first-time buyers, I think that I wanted to talk about something that a lot of people heard of that kind of came and went really fast. It was called the California Dream for All. It was administered by the California Housing Finance Agency. They depleted $300 million in 9 days. So we had people lined up for that program. They didn't get access to it. It wasn't handled quite efficiently as it could have been. So they are working on new guidelines. They do have another funding of $200 million coming. We expect to get those guidelines in the fall. The last time that rolled out, it was a 20% assistance with very high income limits. So people had access to it that really weren't in the first-time buyer realm. Excellent income, super high sales prices. So the money went really fast. I'm hoping that this time around, it'll go a little bit slower and more people will have a swing at it. Also, the Housing Trust Fund of Santa Barbara County currently has funding for 2 additional transactions. They have asked for more money from Cal Home, and they will be awarded their additional funds in September. So again, get with a lender. If you want to start gearing towards these programs, I would say the earlier the better, so you are well and ready to get into contract once these roll out. California Housing Finance Agency also offers their traditional My Home and ZIP programs that are 3.5% assistance plus closing costs. And then the Golden State Financing Authority also offers assistance. You do not have to be a first-time buyer with them. So that's one good thing. If you owned a home a few years ago or just sold and kind of sat on your equity and use that for debt consolidation or whatever, you can still get into a home with assistance without being a first-time buyer. So lots going on in the market. The other question.
It sounds like, if I can interrupt you here, so it sounds like if someone's looking to get into one of these loans that have limited funds, not like Golden State Finance Authority or the ZIP loan, but these Dream for All, that if they're pre-approved and ready to go, they have a much better chance of getting those funds in that short period of time. Whereas if you're having to go, oh, those funds are available, now I'm going to go see a lender, you probably aren't going to make it in time. Is that correct?
That's right. I think if you, and the California Dream for All is statewide. So that would be Silvero, Liz, all of us can help you with that. But the best thing is to get your homebuyer education done, to get your loan credit approved, have all of your income documents in, have everything ready to go. So when that money hits the ground, you can get into contract on something and reserve.
Okay, great. Thank you.
Mm-hmm. So I'm sure we will get lots of questions about that after the end, but yeah, still lots of good programs out there. Income restrictions, each agency has its own set of income limits. The Housing Trust Fund is by family size. CalHFA is just standard by county. And then Golden State Finance Authority doesn't have income limits for government loans. And for their conventional loans, the limits are pretty high. So I think the most conservative is a Housing Trust Fund.
Okay. So that's good to know. So you don't really have to be low income to get these loans. They have sometimes pretty generous qualifying incomes.
They do. One other thing I did want to point out, Corby, if we have enough time, is recently Fannie Mae and Freddie Mac made some changes. So we're considered a high cost area. Ventura is high cost, right, Silverio? We're both high cost areas. And so now Fannie Mae and Freddie Mac have actually improved interest rates. As long as you're not over 120% of the area median income, your interest rate is going to be improved right now. I think it's for the long run. We'll see. but you don't have the traditional add-ons for credit scores, for down payment as other people would. So that is an initiative that they are trying to push to encourage home ownership, first-time home ownership with conventional loans.
Great. So it sounds like there's a lot of good news in the lending market. So that's great. Thank you.
Yep.
And obviously, you know, if you're looking for these first-time homebuyer programs, just meet with a lender, let them know that that's what you're interested in. They usually try to match you with a loan that meets your specific situation. One other question, Cindy, I wanted to ask about the first-time homebuyer. If someone is buying a home with a partner and one has owned a home before and the other hasn't, is that still considered a first-time homebuyer situation?
No.
Okay, so it's both have to be first-time homebuyers.
Correct.
Okay.
If it was their primary residence, and like Silverio and I we were talking earlier before the call, there are exceptions. He went to a Fannie Mae meeting, or he was watching a webinar yesterday.
At CaliHFA, yeah.
CaliHFA, and they said they will make exceptions. So if you owned a home as a co-signer and you didn't live in the property, then yes, you are still considered a first-time buyer. Fannie Mae and Freddie Mac are a little bit different. I'm not sure what exceptions can be made, if any, on owning in the past. I do believe there was a recent guideline change with conventional loans. If you got a divorce, then yes, you can be considered a first-time buyer again, but not applicable for CalHFA. So you really got to get with your lender and decipher all of the information that fits you.
So if we're seeing a theme here, it's get to the lender, get these questions answered, find out what's available to you.
Yeah.
Don't wait. Just, you know, and I think oftentimes what we see is that someone thinks they're not ready to buy right away. They're waiting for a promotion or a raise, and they're thinking that's going to happen in the next year, so they wait. Whereas sometimes they're ready to buy sooner than they think because there is a loan program available, or the lender wants them to work on some credit issues or whatever it is. They can be doing that in concert with that. So sooner rather than later.
One thing, a couple more things to add to that. The Golden State Finance Authority rolled out Golden Opportunities yesterday, which does allow for lower credit scores and higher debt ratios. So that's one that kind of expanded their product. But the key is a reputable lender, Corby, that has expertise in these areas, because like CalHFA, you have to be an approved lender. You have to know their products. The same thing for GSFA. The Housing Trust Fund is very selective on their lenders. So the key is reputable and experienced.
Right. Good. Thank you. So down payment, that's always a big question. Do you, do you need a down payment? Are there low down payment options? You know, how long do you wait to save up for something? Silverio, could you share a little bit about that and what's involved in the down payment process?
Certainly. Cindy did a great job at explaining some of the first-time homebuyer programs. And, you know, again, while there may seem to be a lot of them, in reality, we all basically concentrate on maybe 2 or 3 of them that are really important, and they're the most utilized here in California. One of the things that, you know, definitely we need to start with is explaining that 20% down, like most people would think as a down payment, is not necessary when you're purchasing a property. It doesn't matter if you're a first-time home buyer or somebody who already owns a home. You don't need 20% down for the most part. 20% down, it's basically something that, you know, people, you know, in the past, you know, maybe your parents, grandparents, or whatever had always mentioned to you, because certainly, yes, when you have 20% down, you eliminate a lot of extra things such as PMI or MIP, mortgage insurance premium. But in general, there are loans in today's market that you can acquire with as little as 3%, 3.5%, 5%, and then so on and so forth. With regards to specific loan programs, for example, there are loans that you can do 100% financing. For example, VA. We do have 3 of the largest bases in Ventura County right now. I'm very proud to say that, you know, I've had the opportunity to help hundreds, if not thousands, of veterans over my career, and it's a phenomenal loan. The next one that is a little unutilized, but it just so happens that one of my really good real estate agents, brought up to me this opportunity to create some financing options for a listing in the city of Piru, which is really close to Fillmore, California. And basically that property qualifies for USDA. USDA is a very unutilized loan in today's market because, you know, it needs to be in a rural area. but it allows you to purchase the property with 100% financing. It's just incredible. So, sometimes just thinking outside of the box or looking outside of your area may provide you another option for low down payments, such as this particular property. From there, we go to other down payment options, such as FHA or conventional. So FHA stands for Federal Housing Administration. It's if not, I believe it's the oldest loan in the United States, and it allows you to utilize 3.5% down. FHA and conventional loans are the two most utilized loans in today's market. For sure, conventional is looked at as a better product. Most listing agents would argue that because it does require slightly higher FICO scores, and it requires a better equipped client to be able to qualify for a conventional loan. FHA, as I had mentioned to you in my original intro, you can go with as little as 580, and some lenders may even go with even lower than that. Not the most favorable terms, but obviously, we do encourage every single one of you to check in with your local lender, because even if you don't have the minimum criteria that entails like the perfect buyer, you might still be able to purchase a house.
Great. Okay. And then FHA can also have much higher mortgage insurance associated with that.
Well, yes and no. Yes and no. Very recently, FHA, they just changed their mortgage insurance premium cost to where it's extremely, I guess, affordable, in comparison. Because if you compare somebody that had a 660 FICO score with an FHA versus a conventional loan, conventional mortgage insurance premium would be extremely high, and FHA would be substantially lower. So yeah, let's not we don't want to get anybody confused on that, because FHA is a phenomenal product. We have to explain it to you thoroughly to make sure that fits you as a consumer.
Okay, so good to ask the lender to lay out numbers with the different products and see what the advantages and disadvantages are of each product.
Certainly, yeah. Every time that you purchase a property, you have to take in consideration there's the down payment and there's also closing costs. Those two portions are very important for you to understand up front. Not because you have the down payment, it means that you have enough for your closing costs. And that's where Coastal Housing Partnership, comes into play. And it's really important for everybody that it's listening that Coastal Housing Partnership, is not necessarily just, a group of individuals that kind of participate in this product and this program. We're individuals that are highly experienced that can help you understand how to save more money. For example, if you work with a lender and a real estate partner through Coastal Housing Partnership, for the most part, the actual lender will waive different things such as appraisal fees and some other fees that we may have that could be equivalent to from $500 all the way to $1,700, $1,500, depending. And then certain real estate agents will provide or donate a portion of their commission to help you cover some of those closing costs. So as you initially expressed, Corby, yeah, sometimes we can help you cover even 50% of your costs by working with a combination of a local lender that works with Coastal Housing Partnership and also a real estate agent that works with Coastal Housing Partnership.
Great, good point. And I think Kim's going to put maybe in the chat a link to the network partners that we work with. Yep. I think the important thing to know about the network partners is that we don't select those for you. You choose from that list who you want to work with. So correct. That's up to you, working with someone that you connect with and feel comfortable with. That's your option. So you're not forced into working with someone, but if you are working with someone on that list, you're going to have some very nice savings on your closing costs.
That is correct.
Thanks.
Yeah, the final part of the questions that I had originally provided by you, it was regarding the acceptable sources of down payment and closing costs. So we discussed already with Cindy. She helped us understand that certain products will help you with the down payment or closing costs, but also some of the funds, like Liz was mentioning, you can utilize your own savings. You can utilize retirement accounts. You can even use gifts from qualified family members. Again, that could be a little tricky depending on what kind of product you utilize. So it's important for you to talk to your local mortgage professional regarding a gift. But typically, if you have a mom, dad, uncle, grandpa, grandma, whatever, whomever is willing to gift you some funds, we can definitely use them, to help you qualify for either your down payment and or your closing costs.
Great, thank you. That's so valuable. So clearly, we keep talking about, get with a lender. You've got to meet with a lender. This is such an important first step. Well, Liz, how do you select a lender? How do you know how to choose someone? What do you look for? How are you choosing a loan officer?
Well, when you're speaking of lenders, there's two factors. There's the institution you're dealing with, and then there's the individual loan officer that you're dealing with. In terms of institutions, there is retail, mortgage banking, and brokering. Retail is basically your large, either regional or national banks that they basically have their product. And if you fit into their box, then that works great. If you have great credit, they want usually the A+ borrowers, and it's limited and it can work out well if you fit into that one box. For most of our clients, we're stretching a little bit to get them into homes because of the rising prices. And so a mortgage banker or a broker will have a great breadth of products and investors. So if one doesn't work, you can switch to another. And as the other lenders, Silverio and Cindy were speaking of, there are so many different products with different investors. You really do want to have someone who has access to all of them. As far as the loan officer goes, as was touched on earlier, the experience of the loan officer is key. You will be looking to maximize your qualifying and to be competitive with making offers in this environment. When there's low inventory, you want to be able to utilize every source of income you have. So an experienced loan officer will be able to help you with that. The reputation of the loan officer is also key. Your realtors know which lenders are going to actually deliver. If you've been pre-approved, will they actually be able to close that loan? And others that may offer pre-approvals that aren't as solid. So you want to work with someone that has a really good reputation. They're responsive and give you great service. And again, as in earlier that I mentioned, this is no longer a transaction like it used to be in the old days with a lender. You go in, you apply, you close the loan. You may be working with this person for many months, sometimes years, and you want to be working with someone that you feel really comfortable with, that you trust, that you know has your back and is trying to help you meet your goals.
So helpful. So now it sounds like maybe working with an e-lender isn't the best way to go in terms of having that relationship with a loan officer. If that's what's important, I think sometimes with an e-lender, you don't know who you're going to get on the other end of the phone. Is it a good idea to meet with someone who is local and right here that if you need to? I think most of the time you work with them virtually, but is it a good idea to be able to sit down with them if you need to and know who to talk to and be able to talk to their manager?
Absolutely. There are sellers and realtors, the listing agents, that will not accept an offer from an e-lender. They may, they might not say that outright, but they're going to choose someone who has been qualified that they know will close the loan for them.
That's really helpful. Thank you. Now, a lot of times people will say, well, I'm just going to call around and find out who has the best rates, and then that's who I'm going to pick. Is there a reason that does or doesn't work?
Well, there's several reasons. One is that often a rate can be quoted that is not a rate you'll qualify for. So until you've actually done a full pre-approval and full credit approval with your lender, you don't know if that rate's available to you. Also, if you're not working with someone reputable, they may be throwing out a rate that might have been there last week, but might not be there today. And that rate will change during the process until you lock it down. Until you lock that rate in, the number is sort of meaningless. So if you're comparing, you liked a couple of lenders that you spoke with and you ask them what the rates are on that specific day for your hopefully target scenario, as long as they're within an eighth or a 1/4%, I would say go with the person that you feel the most comfortable with, because the spreads vary day to day, and it depends on what time of day even that you talk to them, it could vary.
Okay. So, and if you're looking to get pre-approved now and you're not ready to buy for 3 months, that lender with the lower rates may have higher rates 3 months later. You just
Correct.
don't know that. Okay.
Correct.
That's really important to understand that.
And in
Okay.
the first time home buyer realm, I would say that most of the products with your lenders are going to be fairly close in price anyways. We're all, getting, from similar sources. So it's really important to rely on who do you think is going to get your loan closed? Who are you comfortable working with? Who has a good reputation, can talk to your realtor, etc.
And who's really going to be a good part of your team and being responsive to your questions in a timely fashion, I think is important, that you feel like you're important to them.
Exactly. And one other factor I meant to mention is that an experienced lender will also understand the employer programs. Maybe your employer, like Cottage, offers a second trust deed program. I had one recently where the borrowers went to Cottage about their second trust deed to get it pre-approved before they'd finished their pre-approval with me, and they were turned down. So I had to actually work with their guidelines, and they looked at things differently than our lender for the first trust deed. So we had to put their application in the way Cottage would approve it. Not that there was anything that wasn't right about it, but first trust deed lenders might look at income a little more harshly. Cottage actually gave them a little bit more income, but then they looked at debts a little more harshly, and their debt to income ratios were lower. So we had to pay off a little bit of debt, but Cottage wasn't going to help them figure that out. You need a really good lender who's there for you to help you navigate that.
Good example. Good point. Thank you. Thank you. So Cindy, how has the lending market changed recently, and how does that impact potential buyers?
Well, overall, we get a lot of questions about, well, is this a good time to buy, right? Why should I buy now? Is it a good time to buy? Is the market going to crash? Everybody's going to lose their value. So we hear that time and time again. And I think what everybody needs to understand is the inventory shortage nationally is in the hundreds of millions of units short to meet the supply of the future homeowners of today. And that's for a few reasons. People are living longer, so they aren't turning over those households. There are more, not baby boomers, what is it, you guys? More people turning age 34 in the nation than ever. And that's the average age of home ownership right now. So the next 5 to 7 years, the demand is going to far outweigh the supply. The last 3 to 5, even 7 years, people have gone into their homes with down payments. They've credit qualified. They've gained equity, and they have interest rates typically below 4%. So those 4 things are a very strong indicator that those people are going to stay in their homes. There will not be a foreclosure crisis. We're not going to have dropping values. They forecast us to still be having equity appreciation for at least the next 5 to 7 years. Maybe cooling off after that, and we aren't going to see the major gains we've seen in the past 3 to 5 years, but we are still going to be seeing appreciation just because of the lack of inventory. So I say it's never a bad time to buy real estate. If you can afford to get into a home, you're going to know that right now is probably going to be the highest interest rate you will ever have, because things should improve here in the next 12 to 24 months interest rate wise. So if you can afford it today and you can qualify today, maybe even understand the benefits of higher interest rates as it affects your tax withholdings on your paycheck. If you're able to bring home more money to help you out with that payment as well, A lot of people don't understand that. So I say it's never a bad time to buy. Still very competitive. So you want to be the best pre-approved buyer you can, like Liz said. You want to know all of your options from a reputable lender, like Silverio said, just being educated and being educated thoroughly. One thing I wanted to add is when Liz was saying, finding the right lender, if you meet a lender that's tight-lipped or doesn't thoroughly educate you, that should be a red flag. You want to have deep conversations. You want them to know you. You want them to know your family, your goals, your budget. Those are all really strong conversations that you should be having when you're trusting somebody to walk you through the process of buying a $500,000 home, right? Most of the time when I get somebody who's met a lender, I'm like, okay, have you looked at your down payment and closing costs? No, they just quoted me over the phone. Have you talked about your budget? No, they just quoted me a ballpark payment. Well, does that payment include taxes and insurance? I don't know. Is there PMI? I don't know. Are you paying points to buy down your loan? I don't know. So when you don't have all those answers, you want to look for another lender. I just wanted to add that, Liz, because that's what I hear time and time again.
Absolutely.
Good point.
And
So
so,
Cindy, you mentioned that we're at pretty high interest rates right now. So if someone buys now and rates drop, are they able to refinance? What's the situation then if they, wind up with 5% rates instead of 7% rates?
yeah, I mean, absolutely. As long as they have the equity in the home, which again, we don't think will be a problem, they're able to refinance to lower rate if rates drop. They would want to be, so where that might change a little bit is if they got down payment assistance from Cal HFA, because their second does have to be paid off in the case of a refinance. Golden State Finance Authority as well. The Housing Trust Fund will subordinate. So there's a lot of different things you want to talk about to be able to refinance in the future. But most of the time, yes, you will have an opportunity to drop your rate.
Okay, so when you're sitting down with a lender and talking about, these choices, do I go with Golden State? Do I go with the trust fund, whatever? Do you kind of lay out, okay, well, here's the advantage here, but you won't be able to refinance until X, or, will they kind of lay that out for you so you understand the pros and cons of each of these financing options?
I do like to lay it all out. Every option we talk about. Sometimes you have lump sum primary mortgage insurance, and you have to worry about if you're going to have PMI again when you refi. If there's a second or third coming into play, if those will have to be paid off, what equity appreciation looks like over the next couple of years. So yes, those things are all super important to consider when you're going into purchasing.
Great, so helpful. So basically, whenever you find a house that you like and you can afford the payment, that's the time to buy, sounds like.
Right. It's not if you're going to invest in real estate, it's when, hopefully. And I mean, the longing for homeownership never goes away. It's still the American dream, right? For most people, one of the things that you always aspire for is to be able to purchasing a home. And I think, I'll talk to people who are working on their credit for 2-3 years and they're still hoping, still coming back, and eventually they get there. It's just, like I said, not if, it's when.
Great, good. Okay, well, let's get to your questions. Kim, what do you see in the questions?
Yeah, we've had Silvero has been answering these questions, so that's been great. When I see that just came in, is it true that when buying a home, there are people that put down a percentage of money to obtain the home?
Sounds like that's maybe deposit. Is that what sound like it's a deposit? You mean in terms of the offer?
Yes, a deposit. Mm-hmm.
A deposit for the offer. Silverio, you want to take that one?
Yeah, that is called the EMD, the earnest money deposit. I'm not quite sure if the attendee is what she's or he or she's asking. But just to kind of clarify, yes, when you're purchasing a property, there are two things that you need to come up with: is the down payment and or the closing costs. And better said, and closing costs. So those are two sections of the purchase that you need to be aware of. And in earnest money deposit, it's an initial deposit that is given to the escrow and the title company to ensure that once your offer gets accepted, instead of a handshake, you put X amount of dollars. So let's just make it simple. Let's assume that the down payment and closing costs are $30,000. But your real estate agent initiated your offer stating that you are willing to put a deposit of $10,000. So within 3 business days of you entering the real estate transaction, you have to either submit a check or a wire for the quantity of $10,000. That means that if you owe $30,000 and you put $10,000, you would only owe $20,000 left at the end of the transaction. I hope that answers the attendee's question.
I think it does. And if we're missing what you're getting at, please put some more information in the Q&A and we'll make sure we address that. Okay, Kim?
Yeah, Silver, I know you were typing to the
Go ahead and ask the question.
question about,
yeah, surely.
yeah. So it's a longer question. It's talking about the interest rate. What programs give low interest rates? This person has an 833 FICA.
Yeah, it's a very specific question that this person's asking. But I mean, in general, I believe Cindy had discussed this earlier today. So look, in part of the question, the attendees asking if they're able to obtain an interest rate at 5%, which I think we all the 3 of us here can attest that having a 5% interest rate, it's more of a 2020 or 2021 era. You know, we haven't seen those rates in a long time. But going back to Cindy's original statement, there are some buy down programs, you know, and I think Corby, you touched on it. So when you have the ability to buy down your interest rate, there are temporary buy downs options that you can buy down your rate by 1 year, 2 years, or even 3 years. Yes, I understand it will fictitiously lower your interest rate for a very short specific period of time. But I can probably ask Liz and Cindy as well if they agree with my statement. But the consensus is that in the next year or two, the interest rates should organically decrease to the point that anybody who has a temporary buy down of 1, 2, or 3 years should see a benefit by refinancing their property at a later time. So in general, what we see, at least, you know, again, I can bring it back to Liz and Cindy, is that the value of purchasing today is because the lack of inventory. Even though you're paying a slightly higher interest rate right now, when interest rates drop, you're going to see hundreds, if not thousands, if not millions of people trying to enter into the market.
Right.
Now, the truth of the matter is this, is that most homeowners today, they have interest rates in the 3%, even sub 3%. So in order for somebody that owns a property that has an interest rate around 3% or so, they're not probably want to sell their property, even if they have if they can receive an interest rate of 4 or even 5%. So we're going to continue to see a lack of inventory for a longer period of time. So for a specific party or like our attendee that has a phenomenal FICO score, has great down payment, great income, I understand that interest rates are a problem for the most part, but you and I cannot control that. The only thing we can do is help you get into the property now and in turn, take advantage of the fair pricing, I guess, of properties now, and then refinance at a later time.
Right. Corby,
Okay.
yes,
Cindy?
that really great.
Sure.
So I was looking at, so this to say this person in the chat, right? So they make $90,000 a year. They're looking at a 600,000 to 700,000 home. I'm assuming that person is single. What I was talking about earlier, as far as tax deductions, is your standard deduction is less than $15,000 a year. So I did a quick calculation. If you're in a 25% tax bracket, which you most likely are, and you buy that $600,000 home, by adjusting your W-4 to your current tax deductions of buying that home will save you between $700 and $800 a month on your income taxes. So You really need to get with a lender who can explain that to you and get you at a comfort level, walk you through your W-4 so that you can see hard numbers on what you will save in your budget to be able to afford that higher payment. You combine that with the buy down, the temporary buy down, you're good to go. It looks like you have a lot of money down to work with. So there are ways to get you in a more affordable mindset to wrap your head around that payment.
Okay,
love that,
that's so
Cindy.
helpful. Yes.
The mindset is the right statement.
Yeah, Kim, let's make sure we can get to all of our questions.
Yeah, let's see. It looks like we don't have, it looks like a lot, I know Silvera went in and kind of typed out a lot of
Let's go
these
ahead and
answers.
just
No,
pick
go
another
ahead
one.
and ask the questions.
Yeah.
Oh,
first.
okay. I'm currently a college student looking to start building credit. Is there a specific bank you recommend?
Liz, do you want to take that?
Well, recommend a bank for establishing credit. I think that any of the banks that you, wherever you have your bank account is a great place to start. They're going to be motivated to keep your business with them. Most retail banks do want to do that. I wouldn't say that I'm an expert on credit cards and establishing credit, but I know that Capital One is pretty good. Any of the big banks, they will offer you credit. So any of those would be fine. Just get something and start using it. Now, one of the things about establishing credit, though, is you want to open an account as soon as possible so that it's established when you're ready to buy a home. So you don't want to go open a credit card right before you're going to go get pre-qualified. So that's a good first step. You can meet with your lender now, but they're going to want you to open any credit card debt you need to get established right away so that you have a history. And the longer you have that open, the better your credit score. Also, there are tiers of charging against it that will affect your credit score. If you keep your balance below 30%, that's best for your credit score. The higher you go, 50, 70, and then when you get close to the top, each tier will drop your credit score. So there's a lot of tricks to know. Talk to your lender first. And again, I would go with the bank where you have your bank accounts first.
I did
Okay,
want to
so-
add something, Corby.
Yes,
Can I?
go ahead.
So a lot of people will come to me and not have any credit. And so they will go apply for a Kohl's card or a Best Buy card. And what people don't understand is department store cards are backed by finance companies and they have a poor scoring model for credit behavior. So if you are not able to get a credit card through your traditional bank, stay with your bank and try to get a secured credit card to where you put your own money up in exchange for credit with a traditional bank card versus a department store card. We do have that a lot. And so if they open a department store card first, it's going to take them a lot longer to build up a credit score versus a traditional bank.
Okay, good to know.
Great statement.
Kim, other questions?
Yeah, this is a great question. Is there a place where we can go to see all the options for first-time buyers? And I wish there was a place. I don't think there is, but I don't know.
Cindy, do you want to take that? I see you saying no, but is there some kind of alternative or?
No, and Google is not your friend.
Yeah, no, for sure.
So don't do an internet search, meet with a lender.
No nerd wallet, no bigger pockets. You need a lender who is reputable, local, and understands navigating all the different nuances of the products.
Mhm.
With we're in a relatively small market where reputations need to be really solid or it spreads like wildfire. Yet we're also a big enough market that we have a lot of really experienced real estate professionals. There's no reason to try to, figure this out on your own. It's important just to meet with a lender face to face or, just have a conversation online with them. But there's no reason not to take that step and find that out from the lender. And there's so many things, I often hear people say, well, I'm going to get this done before I meet with the lender. I want to make sure that this is in good shape, my credit, or, I've saved this amount before I meet with the lender. And I just think meet with the lender now, because the things that we think we're supposed to do may be wrong. So the lender will advise us. So let that lender be part of your home buying team and counsel you through the whole process.
And this is a
But
good
something
one.
else has come in.
Yeah, this is a good one. Are there differences in obtaining a loan for a manufactured home? I've heard you can use personal loans and you cannot get loans on manufactured homes for 15 plus years or older.
Yeah,
Cindy,
there's a lot of
wanna take that,
confusion
Cindy?
on that.
Cindy, you want to take that?
Sure. Well, there's a difference between a manufactured home on a permanent foundation versus a true manufactured in a park. Manufactured homes in a park or in a senior community, typically like that, they're still considered personal property. So I typically refer those people to Community West Bank. Silverio and Liz, you guys might have another outlet, but you do traditionally need more down. You need 20% down. Down payment assistance is not available on those, and which is a struggle. I mean, it's a struggle for all of us, because if you could buy a mobile home, it'd be much more affordable, but it's just, and the reason is they depreciate much quicker. Unless they're put on a permanent foundation and they recorded what's called a 433A, which basically takes them from a mobile home to a single family. And then they're eligible for most of our other products.
Yeah, in terms of the network partners that Coastal Housing Partnership works with that do mobile home loans, it's Community West Bank, as Cindy mentioned, and Montecito Bank and Trust. Both
Great.
offer mobile home loan products with Coastal Housing Partnership savings.
And also understanding, in my opinion, that at that particular point, I think that reaching out to one of the Coastal Partnership real estate agents that actually can refer them over to other institutions outside from the Community West Bank that I had the pleasure of working with, personally. But yeah, there's a few other options. But yeah, like Cindy said, it's very important for everybody to understand that there's a big difference between a mobile home sitting on a permanent foundation where you own the land or when you're leasing the land. It's very, very different.
Kim, any more questions?
Yeah, I know it's 1:03. Do you want me to do one more question here?
Yeah, if you have another question, sure.
Is it true that the first-time home buying programs put a limit on the sale price of a home? If so, how does that work in an impossible market like Santa Barbara when everything is in the millions?
Liz, you want to take that?
Yes, and I may ask for a little help from my friends, but in general, there are limitations on the loan amounts with different lenders. And there are some programs that are targeted towards certain areas that have low income housing. So there are different variables with the income qualifications and with the property qualifications. And I see far less of those in my area. I would probably punt to Cindy or Silverio to take it deeper.
Okay.
Well, I guess in general, Fannie Mae, Freddie Mac, FHA, they have loan limits for each county. Most first-time home buyer programs will adhere to those limits. Certainly, yes. For example, Santa Barbara, I've never understood why Santa Barbara's loan limits are lower than Ventura County's, even though Santa Barbara is a much higher price point. But yes, I do agree. We do see a large number of folks that live, obviously in the area of Santa Barbara that are moving either to the city of Ventura or Ventura County, or even where Cindy's at, more in the Orchid Santa Maria area, to try to minimize the cost of I don't know. I mean, I guess Liz can help with this a little bit more, but I've even seen condos at $800,000 to $1 million in Santa Barbara. So yes, looking for better priced areas will definitely assist you with purchasing a property with a lower down payment option, maybe even a lower price point as well.
Cindy, do you have anything to add to that as we wrap up?
I don't, just the high balance like Silverio added. They're up there in the 8s now, but really it's not, it's difficult.
Yeah, Ventura County is 948,000. So I mean, that's why I would assume that kind of ours should be much greater. But yeah, that's
Yeah,
a great question.
we're at 805,000, so most of our properties don't qualify.
Qualify. Yeah.
Well, we're at just over time here, so we're going to close out, but I just want to express my appreciation to Liz, Silverio, and Cindy for
Thank you for the invitation.
being with us today and for sharing some wonderful information for our attendees, and appreciate what you've done. And thank you, attendees, for joining. And I hope you heard our message loud and clear. Meet with a lender. That's your first step. Okay, thank you. Have a great day.
Thank you.
Thank you.